Hello everyone and welcome to today's webinar. My name is Samantha Peacock, Business Development Director at Landmark Estate Agency Services. Today we'll be exploring the latest anti-money laundering regulations for estate agents, including the updated risk assessment guidance from HMRC that was released in September of this year. This session is recorded and it will be sent to all registered contacts for future reference or sharing with your team. So, why does AML matter? Property transactions, as we all know, involve large sums of money and complex structures, making them attractive for laundering illicit funds. Criminals exploit opaque ownership, offshore entities, and high-value deals. Estate agents are one of the first people in the transaction to come into contact with the clients, and so you are ideally placed to spot suspicious behaviour. Yet despite this, less than 1% of SARS come from a estate agency. We all know that the penalties in terms of fines are growing larger. In June 2025, HMRC published a list showing 336 penalties across all sectors, totalling over 3.2 million. Of these, 194 were estate agents, and their fines came to over £1 million. The majority of breaches were for trading while unregistered. In October 2024 to March 25, HMRC issued 548 notices in 6 months. Fines ranged from £1,250 all the way up to £52,000, with several exceeding £10,000. And AML fines across estate agents have surged in the last few years, reflecting HMRC's intensified enforcement. So it is so important to at least annually be reviewing your processes, ensuring you have up-to-date risk assessments and policies, and updating the training that everybody has. The National Risk Assessment 2025 confirms property as a high-risk sector for money laundering. Estate agents must now evidence how each transaction is assessed against 34 named risk indicators. If you look at the National Risk Assessment, pay particular attention to sections 2, 3, 4 and 5. As an estate agency business, you must take appropriate steps, taking into account the size and nature of your business, to identify and assess the risks your business may be exposed to. You must consider the following risk factors: your customers, the countries and geographical areas of your operations, each type of service that you provide, the size, nature or frequency of your business transactions, and how you interact with your customers. These indicators from the National Risk Assessment were then used to create the new risk assessment guidance from HMRC, which was updated on the 9th of September of this year. You need to update your business risk assessment and policies, controls and procedures to reflect these risk indicators if they aren't included in there already. The characteristics that they have outlined are HMRC's assessment of likely risks that estate agents face. Whilst all the risks must be taken into account in your risk assessments, you may also find additional risks when evaluating your own business. Following the webinar, we shall circulate a more expanded copy of the list of the indicators. But for today, I have condensed them into this slide just to make it easy for you to see what they are. Now, looking through the list, the chances are that most of these you will already have them covered in your risk assessments, and many of them are indicators of behaviour that you would have likely have reported in the past already, or it would have sparked concern. This update is nothing to be alarmed about, so please don't panic. Often with regulation change, it can bring mixed messages in this industry, but this update is simply HMRC's way of trying to provide more clarity on what they mean by normal and high risk. and trying to guide estate agents on things to look out for in client behaviour that would mean that they should be subjected to enhanced due diligence. These risk indicators, however, don't automatically mean a client is high risk. They are simply warning signs to look out for. Instead, you need to think about the number and severity of the risk indicators and the context of them, such as client type or remote client versus face-to-face, and whether indicators combine to create a pattern of concern. For example, a risk indicator of it being a residential property and a politically exposed person, but you've met them face-to-face in the UK. That would be lower risk versus a foreign national pet. So I'll talk through the risk indicators now and try to give examples as to what they mean by them. So firstly, we've got residential property. Transactions at all price levels may be exploited, not just high values. The same with commercial property. Any size could be used to launder funds, so look out also for use of short-term lending structures too, like bridging finance, where they're trying to mask the origin of the money. Super prime properties, such as those over 5 million in London and 1 million elsewhere, they attract higher risk. Consider the customer's profile, such as links between the buyer and seller, with no plausible reason or reluctance to provide documents, or adverse media or past criminal records. PEPs require enhanced due diligence, especially those from a high-risk jurisdiction or those tied to super prime property. Multiple property transactions, so they are repeating sales of the same property in quick succession to obscure the origin of funds, or using multiple lawyers for the same property to conceal links. Also, where a customer has multiple properties for sale and they use multiple lawyers, this indicates higher risk, as it would normally be seen that a customer involved with multiple transactions would use the same lawyers. Is the property price not reflective of market value, and is somebody willing to heavily overpay for a property? Is the customer part of a complex, unusual structure, and so it's difficult to trace who really owns or controls the entity? This is particularly risky when dealing with hidden jurisdictions. Tracing ownership can be difficult where corporate structures are complex. If the transaction involves a legal entity that is not transparent, then this could be a sign of an attempt to obscure the beneficial ownership. You may deal with customers that have corporate structures based overseas, and if anyone involved in a high-risk third country, then they need to be treated as high risk. Intermediaries can pose a risk as they place a distance between you and the customer, so it's important to get to the bottom of who the real customer is. Is it a non-face-to-face interaction? Because this would require more rigorous due diligence. Does the transaction involve somebody who could be a professional enabler, such as accountancy services or financial or legal? They may also enable criminality through negligence of their own compliance with professional and regulatory obligations, and that's known as being a professional enabler. Purchase of property, where the property is then let out, could lead to additional risks if it wasn't apparent from the start it was intended to be let. Is it a transaction with no real commercial purpose or plausible business reason to buy it, such as a non-trading company wanting to make a purchase? The source of funds, are there changes to the bank account partway through a transaction, or use of foreign accounts or cash payments made in multiple currencies, or unexpected changes to financial arrangements? Are there requests to facilitate a property transaction from more than one firm, which share a common beneficial owner, as this could be an attempt to obscure relationships between the firms? Is the customer based from a virtual office address, which means it's not connected to the customer, in order to facilitate anonymity? If the customer is a trust, then trusts are often used as the last step in the money laundering process, after other laundering methods have been used to disguise funds. It's highly likely that criminals favour overseas trusts for laundering money in the UK. Is the customer a real estate investment trust, which is a vehicle that allows an investor to obtain broadly similar returns from their investment as they would have had they invested directly in the property? The right is required to invest mainly in property, and to pay out 90% of the profits from its property rental business, as measured for tax purposes, as dividends to shareholders. The right is exempt from UK tax on income and gains of its property rental business, so right customers need to be treated as high risk. The same applies to open-ended investment companies. Clients that are tied to cash-intensive businesses that are purchasing property that have also been known to be linked to money laundering, such as vape shops, salons, car washes, American candy shops, tanning salons, and so on. These are just examples given in the guidance, and if they are related to them, then the cash just needs to be treated with caution. Working with another estate agency as a joint venture could pose a risk in HMRC's eyes if you are reliant on them for client due diligence documents, so take caution here. If it's sold at auction, that tends to be faster, giving less time to scrutinise the case, so there are more risks involved. If you are using a third-party AML provider, you need to know that you have quality checks. Landmark checks are of the highest standards, and they meet the criteria for the Digital Identity Trust Framework, which is a UK government initiative that defines rules and governance for digital identity service providers. And this provides certification for providers that meet the trust framework requirements, so you have peace of mind with the quality of our checks. They match to multiple data sets, both positive and negative, such as Experian, PEPs, sanctions, fraud alert, deceased alert, address matching, biometric facial recognition, plus ID verification, as well as NFC chip reading. We provide a very detailed report with a pass or refer response, with an explanation for every verification measure, and the outcome with a time-stamped audit trail. You need to be running robust sanctions checks to ensure that you are not operating with any sanctioned individuals. The estate agency sector is assessed as low risk for terrorist financing compared to money laundering, but the possibility exists, so robust controls should still be maintained. Proliferation financing refers to funding or facilitating the acquisition or manufacture of weapons of mass destruction or related materials. Sanctions regimes and laws against proliferation financing apply, and certain countries or entities are designated for this purpose, but the Landmark checks will run a check against the sanctions list. So how can Landmark help? Following this webinar today, we will circulate to you a copy of the risk indicators. We'll also show you a recording of this webinar so you can look back over it if need be. Landmark do so much to help our customers to be compliant with the regulations. We provide you with a free template money laundering policy and business risk assessment so that you can adapt this to your company. We also have a free digital client risk assessment within the Landmark Agent system, so you can complete that on each person tied to a transaction, and that's a free tool to use as well. We also give you access to Landmark Academy, which is free online training courses on the regulations, and you get a certificate at the end as well, so that you can evidence staff training. If you are to use our system, then it's completely free to be set up. You can have as many users as you like. We will take care of all the training, and you'll be assigned a dedicated account manager that is there for support not only on the system, but also for queries on the regulations themselves. We can cover all types of situations, whether it's a UK national client or it's somebody overseas, whether it's a politically exposed person or probates or trusts. We have a way around to be able to help you verify that person. Our checks are simply pay as you go. You order as much or as little as you need and you get invoiced at the end of the month, and we simply charge one fee per check. We offer a facial recognition check as well as a standard AML check, and you can also order land registry checks at the same time. If you're interested in knowing more about our system, then please don't hesitate to get in touch following this webinar. Thank you so much for listening today.